The quarter started off reasonably well with a fairly strong rebound across most markets following what had been a pretty difficult third quarter. But really, as the year came to an end, it became an increasingly volatile and difficult environment, economically, from a market and from a geopolitical perspective. Now, in that context, our Momentum Diversified Target Return Fund delivered a small but a positive return of 0.8%. So really thinking about the fourth quarter and what resulted in that return, it was really our exposure to global developed equity markets, complemented with a bias towards quality companies, that really were the two allocation decisions I think that were the most beneficial to our performance. Now, our exposure to emerging markets, which runs at sort of roughly 6% of our fund, it also aided returns, as emerging markets, really in sterling terms, delivered a very similar return to the UK equity market. But within equities, our selected global equity managers, they really continue to lag the broad market. And it's really been our value-orientated managers that have continued to underperform. It's not too surprising, given that their investment approach leads them to be more drawn towards the cyclical part of the market, which I think today would be your industrial, your capital good, and your commodity-linked businesses. And it's really those sectors that have materially underperformed in the current economic environment. Now, thinking of the fixed income component of the portfolio, it's our exposure to high-yield corporate debt that's really been the main detractor of performance over the past quarter. Now, credit, but more specifically high yield, it experienced a very difficult year. We've had issues of increased corporate indebtedness and the prospect of increasing defaults, particularly in the energy sector, that have clearly been on the forefront of investors' minds. But if I think about it, it's really that closure of a few high-profiled, aggressive high-yield funds at the end of last year that really knocked confidence in the market. I think all in all, high yield probably fell around 2% over the quarter, and about 4.5% for the full year. But of course, our fund is invested in a number of different fixed income strategies, and it was our allocation to the other strategies, mostly investment-grade debt, the convertible bonds, and even the hard currency emerging sovereign debt, that was able to offset to some extent the losses that we experienced from high yield. So despite this fairly gloomy backdrop of disappointing global growth and increasing risks, your traditional safe haven assets produced mediocre returns at best. The UK gilt market was sort of 1.3% low over the past quarter and only produced a marginal sort of 1.2% for the entire year. I think the reason there is with yields at exceptionally low levels and the prospect of higher rates in the US and certainly at some point in the UK, there's been really little room for yields to contract meaningfully. The global economy has certainly softened, but our view is that the developed world should continue to grow modestly through 2016. Now, although the Fed has made its first upward move in this rate cycle, further increases are likely to be fairly gradual, and the European Central Bank and the Bank of Japan are certainly going to maintain their ultra-loose monetary policy for the next 12 months. Employment growth continues to be strong, particularly in the US and the UK, yet wage rises remain subdued. I think inflation is unlikely to be an issue in the years ahead. Markets have fallen a lot, and they're discounting a lot of negative news and concerns. And we believe that most of the falls in commodity prices are behind us, but we've yet to see that offsetting impact of lower commodity prices feeding through into consumer spending. So despite a tough earnings environment for corporates, our view is that there'll be modest growth this year. And of course, valuations across many asset classes have improved materially. If anything, the volatility and nervousness across markets could well result in central bank policy being kept looser for longer. I think further weakness in developed equity markets could certainly provide a great opportunity for the Diversified Target Return Fund to add to equity positions at now increasingly attractive valuations.